This is the first monetary policy statement of 2024, a momentous year for the Reserve Bank of India, which enters its 90th year of existence and operations on 1st April this year. Over the years, the Reserve Bank has established itself as a credible institution which stands for stability, trust, and economic progress. In recent years, it has become a pioneer in fostering innovation and technology in the financial system. Customer centricity and financial inclusion have always been its priorities. The Reserve Bank's tireless efforts towards maintaining a fine balance among price stability, financial stability, and external sector stability have paid rich dividends as the country embarks on a higher growth trajectory in the years to come. As India gains a pole position in the new global order, the contribution of the Reserve Bank is getting widely recognized both within and outside the country. The global economy continues to present a mixed picture. On the one hand, the odds of soft landing have increased, with inflation moving closer to the target and growth holding up better than expected in major advanced and emerging market economies. On the other hand, the ongoing wars and conflicts and the emergence of new flashpoints in different parts of the world, with disruptions in the Red Sea being the latest in the series, impart uncertainty to the global macroeconomic outlook. In this unsettled global environment, the Indian economy has performed remarkably well in the recent years. Growth is accelerating and outpacing most of the forecasts, while inflation is on a downward trajectory. At the current juncture, India's potential growth is propelled by structural drivers like improving physical infrastructure, development of world-class digital and payments technology, ease of doing business, enhanced labor force participation, and improved quality of fiscal spending. Our multi-pronged, proactive, and calibrated policies on the monetary, regulatory, and supervisory fronts have worked well to maintain and strengthen macroeconomic and financial stability. Let me now turn to the decisions and deliberations of the Monetary Policy Committee meeting, the Monetary Policy Committee, which met on 6th, 7th, and 8th of February, that is culminating today. After a detailed assessment of the evolving macroeconomic and financial developments and the outlook, the Monetary Policy Committee, that is MPC, decided by a 5-to-1 majority to keep the policy rate unchanged at 6.5%. Consequently, the standing deposit facility rate remains at 6.25%, and the marginal standing facility, that is MSF rate, and the bank rate at 6.75%. The MPC also decided by a majority of 5 out of 6 members to remain focused on withdrawal of accommodation to ensure that inflation progressively aligns with the target while supporting growth. I shall now briefly set out the rationale for these decisions. The momentum in domestic economic activity continues to be strong. Headline inflation, after moderating to 4.9% in October, rose to 5.7% in December 2023. This was primarily due to food inflation, mostly vegetables. The softening in core inflation, that is CPI inflation excluding food and fuel, continued across both goods and services, reflecting the cumulative impact of monetary policy actions as well as the significant softening in commodity prices. The uncertainties in food prices, however, continue to impinge on the trajectory of headline inflation. Taking into account this growth inflation dynamics and the fact that transmission of the cumulative 250 basis points policy rate hike is still underway, the MPC decided to keep the policy repo rate unchanged at 6.5%. The MPC will carefully monitor any signs of generalization of food price pressures which can fritter away the gains in easing of core inflation. Monetary policy must continue to be actively disinflationary to align inflation to the target of 4% on a durable basis. The MPC will remain resolute in this commitment. The MPC also decided to remain focused on withdrawal of accommodation to ensure fuller transmission and anchoring of inflation expectations. I now propose to provide an assessment of growth and inflation. Let me take up first global growth. Global growth is expected to remain steady in 2024 with heterogeneity across regions. Though global trade momentum remains weak, it is exhibiting signs of recovery and is likely to grow faster in 2024. I would like to mention that, I am making several statements, and the supporting data for all the statements that I am making, all the sentences that I am reading out, the supporting data is provided in the footnotes. So therefore, those of you who are interested can refer to the footnotes for the backup data in support of whatever statements I am making here. So let me just restart so that there is continuity. Global growth is expected to remain steady in 2024 with heterogeneity across regions. Though global trade momentum remains weak, it is exhibiting signs of recovery and is likely to grow faster in 2024. Inflation has softened considerably and is expected to moderate further in 2024. Financial markets are volatile as market participants adjust their expectations on the timing and pace of rate cuts by major central banks, who in any case remain cautious against premature easing in their fight against inflation. Amidst the current headwinds, elevated level of public debt is raising serious concerns on macroeconomic stability in many countries. Now, this is a new point which I am just introducing, which I am talking about in this MPC, because this aspect, I think, is an important aspect and it will impact the future trajectory of global financial stability and global financial system. So therefore, this point I thought I must mention here as a part of the monetary policy statement. Now, amidst the current headwinds, elevated levels of public debt is raising serious concerns on macroeconomic stability in many countries, including some of the advanced economies. Global public debt to GDP ratio is projected to reach 100% by the end of this decade. The public debt levels in advanced economies, in fact, are much higher than those in the emerging market economies. The challenges of debt sustainability in an environment of high interest rates and low growth at the global level can become new sources of stress. Reducing debt burdens is necessary to create fiscal space for new investments in priority areas, including green transition. Now, in this context, so far as India is concerned, going by the budget which has now been presented, I think government is adhering to a path of fiscal consolidation, and as per the projections made by the International Monetary Fund also, India's that is general government, the debt of both central and state governments are expected to moderate in the years to come. This is just a point of information to put things in the context. Domestic growth. Domestic economic activity remains strong. The first advance estimates placed the real gross domestic product, that is real GDP growth, at 7.3% for 2023-24, that is for the current year, making this the third successive year of growth of above 7%. Going forward, the momentum of economic activity witnessed during the current year, that is 23-24, is expected to continue in the next financial year also, that is in 24-25. Agricultural activity is holding up well despite lower inflation, lower reservoir levels and delayed sowing. Rabi sowing has surpassed last year's level as well as the normal acreage. The allied sector is also expected to provide major support to agriculture with continued momentum in horticulture and fisheries. Industrial activity is gaining steam on the back of improving performance of manufacturing. The early results of corporates in the manufacturing sector remain upbeat, driven by higher profit margins. The Purchasing Managers Index, that is PMI for manufacturing, is displaying expansion along with strengthening of Future Activity Index. Services sector activity is expected to remain resilient on the back of strong domestic demand and stable global prospects. The PMI services increased significantly in January, that is January this year, suggesting continuing strong expansion. The buoyant demand for residential housing, coupled with increased thrust on government capex, is expected to propel construction activity. On the demand side, improving employment conditions and moderating inflation, together with a rebound in agricultural activity, should push up household consumption. Rural demand continues to gather pace. Strengthening farm level activity as reflected in declining Mahatma Gandhi Narega demand and the extension of Pradhan Mantri Garib Kalyan Anna Yojana should further support rural consumption. Urban consumption remains strong on the back of improved income levels. Investment cycle is also gaining momentum, is gaining steam, aided by sustained thrust on government capital expenditure, increased capacity utilization, rising flow of resources to the commercial sector, and policy support from schemes such as production-linked incentive. Revival in private corporate investment is also underway. Our survey suggests that investment intentions of private corporates remain upbeat and both services and manufacturing firms are optimistic about overall business conditions. Next, net external demand is also improving with narrowing merchandise trade deficit. Now, taking into account all these factors into consideration, real GDP growth for 2024-25, that is the next financial year, is projected at 7%. I repeat, real GDP growth for 2024-25, that is next financial year, is projected at 7%, with Q1 at 7.2%, Q2 at 6.8%, Q3 at 7%, and Q4 at 6.9%. The risks are evenly balanced. Let me now turn to inflation. Headline inflation moderated to an average of 5.5% during April to December 2023 from 6.7% during the whole of 22-23. Food price inflation, however, continued to impart considerable volatility to the inflation trajectory. In contrast, the deflation in CPI fuel deepened and core inflation moderated to a 4-year low of 3.8% in December. The decline in core inflation continued to be broad-based, with inflation remaining steady or softening across its constituent groups and subgroups. The inflation trajectory going forward would be shaped by the outlook on food inflation, about which there is considerable uncertainty. Adverse weather events remain the primary risk, with implications for the Rabi crop. Increasing geopolitical tensions are also leading to supply chain disruptions and price volatility in key commodities, especially crude oil. On the positive side, the progress in Rabi sowing has been satisfactory and augurs well for the season. Prices of key vegetables, especially onions and tomatoes, are registering seasonal price correction. Taking into account these factors, CPI inflation, that is consumer price headline inflation, is projected at 5.4% for the current year, that is 23-24. So that is for the current year 23-24, we are projecting CPI inflation at 5.4%, with the fourth quarter, that is the current quarter, projection of 5%. Now, assuming a normal monsoon for the next year, CPI inflation for the next financial year 24-25 is projected at 4.5%. I repeat, CPI headline inflation for next financial year 24-25 is projected at 4.5%, with Q1 at 5%, Q2 at 4%, Q3 at 4.6%, and Q4 at 4.7%. The risks are evenly balanced. Now, what do these inflation and growth conditions, what do they mean for monetary policy? Let me try and answer. Inflation has seen a significant moderation from the highs of the summer of 22. That is the summer of 2022. Over the last 2 years, monetary policy has prioritized inflation over growth, undertaking calibrated increase in policy repo rate by 250 basis points and withdrawal of stimulus measures. Monetary policy was supported by proactive supply-side measures by the government. That said, the job is not yet finished, and we need to be vigilant about new supply shocks that may undo the progress we have made so far. Headline inflation has remained high and has seen considerable volatility, moving in a range of 4.3% to 7.4% during the current financial year. Recurring food price shocks could interrupt the ongoing disinflation process, with risks that it could lead to de-anchoring of inflation expectations and generalization of the price pressures. Adding to these are the renewed flashpoints on the geopolitical front, including supply chain disruptions. Importantly, the CPI inflation target of 4% is yet to be reached. Monetary policy in the midst of these lingering uncertainties has to remain vigilant to ensure that we successfully navigate the last mile of disinflation. Now, the last mile of disinflation is always the most challenging, and that has to be kept in mind. Stable and low inflation at 4% will provide the necessary bedrock for sustainable economic growth. This point is very important, because if we are interested in the long-term growth of our economy, then we need a regime of low and stable inflation. That is why we remain focused on bringing the inflation, to align the inflation to the target on a durable basis. I would now like to focus on the liquidity and financial market conditions, about which there is a lot of interest in the financial markets and also elsewhere. After remaining in surplus during April-August 2023, system-level liquidity turned into deficit from September after a gap of 4.5 years. Adjusted for government cash balances, potential liquidity in the banking system is still in surplus, and that may surprise you. But adjusting for government cash balance, potential liquidity in the system is still in surplus. During December-January, the Reserve Bank proactively injected liquidity through both the main and the fine-tuning repo operations to ease liquidity tightness in the system. With government spending picking up and augmenting system-level liquidity, I must mention that in the recent, particularly in the second fortnight of January, government expenditure was sustained. But I think there has been a significant pickup from the second fortnight of January, and also we are witnessing the same in February. And So with government spending picking up and augmenting system level liquidity, the Reserve Bank undertook 6 fine-tuning variable rate reverse repo auctions, that is VRRR auctions, during February 2 to February 7, 2024 to absorb surplus liquidity. Financial market segments have adjusted to the evolving liquidity conditions in varying degrees. While the short-term rates have fluctuated, long-term rates have remained relatively stable, reflecting better anchoring of inflation expectations as indicated in the softening of term spread in the government securities market. In the credit market, however, monetary transmission remains incomplete. Let me reiterate, and this is very important, let me reiterate that our policy stance is in terms of interest rate, which is the principal tool of monetary policy in the current framework. Our stance of withdrawal of accommodation should be seen in the context of incomplete transmission and inflation ruling above the target of 4%, and our efforts to bring it back to the target on a durable basis. So far as liquidity conditions are concerned, these are being driven by exogenous factors which are likely to correct in the foreseeable future, aided by our market operations. On our part, the Reserve Bank remains nimble and flexible in its liquidity management through two-way main and fine-tuning operations in both repo and reverse repo. So you would have noticed we have done two-way, market interventions, both repo and now reverse repo. And we have been very nimble even during one particular day, like yesterday and the day before. On a single day, we conducted 2 VRRR auctions on a single day. That was seen yesterday and day before, and that goes to show that we are nimble and swift in our response to the evolving liquidity conditions. Now, I would like to emphatically state here that we will deploy an appropriate mix of instruments to modulate both frictional and durable liquidity so as to ensure that money market interest rates evolve in an orderly manner and financial stability is maintained. The reversal of liquidity facilities under both SDF and MSF, even during weekends, which we announced in the last, that is in December policy statement, has actually facilitated better funds management by the banks. As of February 7, 2024, the Indian rupee has remained stable compared to both its emerging market peers and even a few advanced economies. In terms of coefficient of variation, the Indian rupee exhibited the lowest volatility in 2023-24 as per the data available between April to January of the current financial year. Now this I am saying compared to the corresponding period in the previous 3 years. Let me reiterate that the exchange rate of the Indian rupee is market determined. Its relative stability in the recent period, despite a stronger US dollar and elevated US Treasury yields, reflects the strength and stability of the Indian economy, its sound macroeconomic fundamentals, financial stability, and improvements in India's external position, particularly the significant moderation in current account deficit, comfortable foreign exchange reserves, and return of capital flows. Now, the confluence of all these factors put together have ensured that the Indian rupee, the exchange rate of the Indian rupee, has remained fairly stable over the last 1 year or so. I would now like to touch upon financial stability. The domestic financial system remains resilient with healthy balance sheets of banks and financial institutions. The financial parameters of non-banking financial companies, that is NBFCs, are also improving in tandem with those of the banking system. Good governance, robust risk management, sound compliance culture, and protection of customers' interest are of paramount importance for the safety and stability of the financial institutions as well as that of individual financial institutions. The Reserve Bank lays great emphasis on these aspects. We expect the regulated entities of the Reserve Bank to accord the highest priority to these functions. External sector is the next area on which I would like to touch upon. India's current account deficit declined sharply to 1% of GDP in the second quarter of 2023-24, that is second quarter of the current financial year, from 3.8% in the second quarter of the previous year. Going ahead, the net balance under services and remittances is expected to remain in large surplus, partly offsetting the trade deficit. India's services exports remained resilient in October to December this year, driven by software, business and travel services. Moreover, with around 10.2% share in world telecommunications, computer and information services exports, India is a significant player in the world software business. According to the World Bank, with an estimated $135 billion inward remittances in 2024. I repeat, the World Bank estimates the inward remittances for India to be in the order of $135 billion in 2024. Now with this, India would remain the largest recipient of remittances globally. Thus, current account deficit for both 2023-24 and 24-25 is expected to be eminently manageable. On the financing side, net foreign direct investment stood at $13.5 billion in April to November 2023, as compared with $19.8 billion a year ago. Foreign portfolio investment, that is FPI investment, witnessed a sharp turnaround during 2023-24, that is current year up to February 6, with net FPI inflows of $32.4 billion as against net outflows of $6.7 billion a year ago. Net accretions to non-resident deposits and net inflows under external commercial borrowings were also higher during the current year. As on February 2, 2024, India's foreign exchange reserves stood at $622.5 billion. Vulnerability indicators suggest greater resilience of India's external sector. We are confident of comfortably meeting all our external financing requirements. I shall now announce certain additional measures, and some of these measures are very important, so I request your patience. The first measure I wish to announce is review of the regulatory framework for electronic trading platforms. The Reserve Bank's extant regulatory framework for electronic trading platforms was issued in 2018. In view of the subsequent developments in markets, products and technology, etc., a revised regulatory framework for these electronic trading platforms will be issued for stakeholders' feedback. The next announcement relates to hedging of gold price risk in the OTC market, that is over-the-counter market in the International Financial Services Center, IFSC. In December 2022, the Reserve Bank had permitted resident entities to hedge their gold price risk in recognized exchanges in the IFSC. It has now been decided to allow resident entities to hedge the price of gold. Now let me just read it again. It has now been decided to also allow resident entities to hedge the price of gold in the OTC segment in the IFSC. This will provide more flexibility to resident entities in hedging their exposure to gold prices. The next announcement is actually very important and has far-reaching consequences. Particularly, it is something which will really benefit the small borrowers from the, from the lending sector, from banks and other entities. At present, and that relates to, key fact statement, that is KFS for retail and MSME loans and advances. At present, the loans and advances availed by borrowers, apart from including the rate of interest, also include other fees and charges, such as the processing fees, documentation charges, etc. So as a result, what happens is that the customer, he knows that the loan carries an interest of so much percentage, but then there are other charges and fees, etc., which he pays upfront. Now, that also needs to be loaded into the actual interest rate. So the customer has a clear idea that what is the actual annualized interest rate that he pays. And this is something on which, as you are aware, as I have said a little earlier, customer centricity is something on which the Reserve Bank lays a great emphasis in the overall public interest. Now, to enhance transparency in disclosure of such information, that is information on various charges, fees, etc., the Reserve Bank had mandated certain categories of lenders to provide the borrower a key fact statement, that is KFS, containing essential information such as all-inclusive annual percentage rate and recovery, and also details of the recovery and grievance redress mechanism. The requirement of the key fact statement is now being extended to cover all retail and MSME loans. This measure will lead to enhanced transparency in lending and will enable customers in making informed decisions. The circular will be issued separately. Obviously, we have to give some time to the banks to comply with these requirements, because quite a few preparatory action needs to be taken at the end of the banks. The next announcement relates to enhancing the robustness of AEPS. Aadhaar-enabled payment systems, that is AEPS, has played an important role in financial inclusion by enabling customers to make digital payment transactions through service providers such as business correspondents. Given their significance, it is proposed to streamline the process for onboarding of AEPS service providers and introduce some additional fraud risk management measures. This measure will further strengthen the security of the AEPS system and enhance its robustness. The next announcement relates to principle-based framework for authentication of digital payment transactions. Over the years, the Reserve Bank has proactively facilitated introduction of various mechanisms such as additional factor of authentication for securing digital payments. While no particular mechanism was specified by the Reserve Bank, SMS-based OTP, that is one-time password, has become very popular. With technological advancements, however, alternative authentication mechanisms have emerged in recent years. Therefore, to facilitate adoption of alternative authentication mechanisms for enhancing the security of digital payments, it is proposed to put in place a principle-based framework for authentication of such transactions. The next and the final announcement, the last announcement, relates to introduction of programmability and offline functionality in central bank digital currency pilot projects. The CBDC, that is Central Bank Digital Currency Retail, the CBDC retail pilot currently enables person-to-person and person-to-merchant transactions. It is now proposed to enable additional functionalities of programmability and offline capability in CBDC retail payments. Programmability will facilitate transactions for specific or targeted purposes, while offline functionality will enable these transactions in areas with poor or limited internet connectivity. I now propose to conclude. The Indian economy is making confident progress on a strong, sustained and transformative growth path. Domestic and international investors are reposing greater confidence on India's economic prospects. In our assessment, the current setting of monetary policy is moving in the right direction, with growth holding firm and inflation trending down to the target. Therefore, much has been achieved, but we must remain vigilant. Policy making during uncertain times has to be based on a continuous assessment of the incoming data and its implications for the evolving outlook. We reaffirm our commitment to bring down inflation to the target of 4% in a timely and sustainable manner. Price and financial stability are the foundations for strong, sustainable and inclusive growth. Our endeavor all along has been to take a holistic approach to keep the economy in balance. We must not only preserve the hard-earned strength and stability of the Indian economy, but also build on this further for a long haul of higher growth with price and financial stability. In the current environment, what Mahatma Gandhi said long ago remains very relevant, and I quote, "I am moving cautiously, watching myself at every step. I repeat, I am moving cautiously, watching myself at every step. But there is the fixed determination behind every act of mine." Thank you. Namaskar.